Good morning. This is Ken Long from Tortoise Capital with a review of the weekend trading report for August 3rd, 2013. The market is in bullish quiet condition. On an annual basis, using weekly RSI 14, it's at 72 out of 100, so into the overbought. On a 10-day basis, shorter term, using the 10-day NDX, we're at 99 out of 100, so also well overbought. Looking at the market mosaic additional indicators, percent stretch relative to the 200-day moving average is green bullish at 11.92%. The slope of the 50 at 0.27 is relatively weak. The ADX still is in neutral territory with a 20.3 reading, so there's still room for an intermediate term bounce to occur. ATR percentage is very quiet at 0.71%. The risk index, which is the 30-period moving average of the VIX divided by the 10-period moving average of the VIX, is at 1.12. Because that's greater than 1, we're in a risk-on condition, meaning it favored riskier assets. The Z-score of that reading of 1.12 compared to the last 5,000 days is at 1.44. Standard deviations above the 5,000-day average. This is a 90-day time series of that indicator. You can see that the decline of volatility has peaked at +2, and now it's coming back more towards the norm, although 1.44 is still exceptionally above average here on declining volatility. Blended monthly rebalancing, no change until 1 September. The ETF2 portfolio, the theoretical models at 70% exposed. The model portfolio is at 80% exposed. You can still see that it favors the U.S. with, in the 32 ETFs, it's financial, small caps, and consumer discretionary, and then 13 ETFs is small caps, mid caps, and then tech. Blended monthly rebalancings. Currently, you can see there's still about an equal mix between buy and cash, with the U.S. dominating the smaller portfolio universe there. And within the 32 ETFs, small caps, financials, discretionary, everything is still U.S. until we get all the way down to Japan. And again, about half of the broader set are on buy signals, half on cash. Generally speaking, weakness in emerging markets, Latin America, commodities. Looking at the market health check. Dark blue area is the river. That's the 30-period Bollinger Band ±1. The lighter blue shaded area is the floodplain ±2 standard deviations. Thick black line is the 30-period regression line. Outer black lines are the regression channel formed by the maximum excursion during the look-back period. The orange ribbon is the 2-period Bollinger Band, which we treat as real price. Purple line is what had been a swing high at 170, and we just got 2 days of closure above that. That's very favorable. The horizontal red lines are support levels that have held in the past. It looks to me like 165 and 157 are very strong support. This used to be resistance. It's now support. The next closest support level to me is about 167 3/4. This last 20 days worth of gains looks like it's holding. I like the decline in volatility throughout this period, and the fact that we were able to close and hold over the weekend above 170 has got to be seen as very favorable. See, ADX has just ticked above 20 with bulls in charge, and what that says is that from this base, we can still see potential for an intermediate term gain, much like if we look back in time, this is the nearest base of support here, and gave us about a 3-week move here, and then there was another one right here and gave us that kind of move. So the argument would be is that 20 days worth of basing here, and we're beginning to see the next leg up. PPO sort of agrees here. We had this nice move up. It terminated in this blue circle right in this area of consolidation. That uptrend was over, but it failed to fail. And now we're starting to see another leg up. It can stay overbought for long periods of time. Even this little pullback only brought it back to the 50-yard line here on Williams percent R. So this has got to be considered very favorable for the long side. Looking at the ETF regional report. 3 out of the 10 regions are on cash, 7 are on buys. That's why we're at 70% invested, 30% cash, and remain there. In the theoretical model, we're bull quiet. The S&P at 57 is stronger than EFA, the Euro-Asia blend at 50. Inside the U.S., the strength is small caps, mid caps, large caps, then tech. 2 strongest sectors, U.S. smalls and mids. 2 weakest sectors are Latin America at 32 and Asia less Japan at 38. Inside the U.S., everything is favorable. Real strength here under the strength column: financials, industrials, healthcare, and discretionary. World market model starting with the U.S. in the middle. Everything small cap is well above average. The rest of the U.S. is above average. China remains well above average. Only Malaysia joins it above average, and Asia less Japan. That's where that weakness is coming from. This is at EPP, Asia less Japan here. Japan remains above average. Private equity and oil are above average. Meanwhile, the rest of the commodities and real estate and bonds are lagging. Everything Europe is above average. Everything Latin America and emerging markets suffering. You can see the dominance of the U.S. business sectors right now. In every case, they are equal to or better than their global counterparts. Consumer discretionary is strong across the world. ETF 30, little change among the leadership. It's still this cluster of small caps, clean energy, biotechs, financials, things that are green in strength but white in consistency are ones where the current strength is moving up faster than the 10-week moving average, and therefore we would think of these as emerging leaders. So this small cap growth, more small caps, healthcare and financials, more small caps. And so you can see where this is relatively new strength in the market. The old reliable ones continue to do well with pharmaceuticals, retail. So leaders continue to lead. Inside the Dow 30, same lens, and these are compared against that 1500 ETF database, so you can see where these large caps are with respect to the rest of the world opportunities. Hewlett-Packard continuing to dominate it, nudged above 27 earlier last week, still solid at the top. United Tech is green on strength, white on consistency, as is 3M. That means they're both emerging strength leaders. Whereas you can look at Disney with a white on strength and green on consistency, as well as Microsoft are fallen from grace. They used to be among the strength leaders, and now they're suffering. The two or three weakest down here, Alcoa and Caterpillar, continuing to just lag the rest of the market, and that's a function of that sector spider of basic materials and industrials are lagging. But the important point is that even the weakest members of the Dow are at least in the yellow and not the red. So that's the world is tilted towards U.S. large caps and has been that way for a while. Just some reference slides on liquidity. Shifting to the daily report now. Got a number of channeling and overreaction signals. ExxonMobil, a 5-day down. Lots of 551 candidates to choose from. That's very favorable. And then the auto framer are those that are better than 2 to 1 on reward to risk. You can see just how much volatility has come out of the market. This is about as quiet as it can be. And so in my view, if you're still swing trading XIV, pay close attention to your stops. It's hard for the market to get quieter than this, and you can already see on the risk index that the dramatic volatility sell-off has already occurred, and now it's drifting back towards the normal. This move here in the risk index corresponds to this decline in volatility over the last 20 or 30 days. So that's a very tradable move. And in fact, this increase in volatility here corresponds to this move here when it got down to extraordinarily volatile conditions. So what I'm saying is be aware of the potential for change in volatility here in the short term. Dow tactical summary. Only ExxonMobil tests out better than 2 to 1 on the reward to risk. For the auto framer, you got a handful of dojis. ExxonMobil, though, looks to be very interesting. The leaders from Friday, Disney and Hewlett-Packard. Hewlett-Packard, I just think you have to love. It's been an extraordinary success story. Remains at the top of the Dow. I look at every time it pulls back as a buy on dip opportunity. Among the ETFs, a handful of dojis. More choices here in the auto framer. The VIX came in at RSI 2 of 2, and again that's that's not like a regular ETF. However, it is at the end of an extraordinary sell-off period, so I'm very cautious about. Even though I've had success with XIV down here with this swing trade, I'm also sensitive to that. It's harder for it to get much quieter than it is. Just opportunities here in the auto framer. The 30-day regression line and the power function in here, so it looks like it's fully valued. The slope of the regression line, hard for it to get much steeper up than this. We would have to see another extension up for it to continue to maintain this level of steepness. You can see on a time series basis, this is what the end point of 30 days of uninterrupted joy really looks like. That's how steep and how good it can be. And then the last time that it got to this level, it did that. Now, it hasn't crossed its 10-day moving average yet at a distance greater than 1 standard deviation above average. But when it does, you can get this kind of a move from, an 8 to 10% sell-off just like that. And that's how quickly it can change. So basically I'm saying respect your stops. Just some reference charts. Just notice how bad the VIX is over multiple time frames. Not quite as bad as Microsoft's sell-off, but these are all Z-scores here. What I like about the small caps here is that on a 5 and 10-day basis, they are not even overdone. So you're not at the end of a run. Looking at the price with respect to the river, you can see that it pulled back to the to the edge of the north shore of the river and then found support and continuing to go above 170. No resistance overhead. What's not to love? The slope of the 90 continues to improve. It's almost out of its z-score river here. This is plus or minus 1 standard deviations for each of those 3 time series. You see the 10 has found support and starting to get ready, and it's just now starting to emerge some more. The 30, however, is fully valued here, I guess we call it, at 2 standard deviations. Hard for it to get much better, but it can stay that way for a good long while. So I remain optimistic. Just more reference data. I'll let you pause that as needed. There was a question by email about quality reports, and I will cover that, what the color codings mean. I'll cover that in the webinar tonight. That's everything I want to cover for the executive summary. It's Ken Long from Tortoise Capital. Keep your risk measured and your powder dry.